This is the audience.
Building credit. This is one of the biggest concerns among teenagers and young adults. Unfortunately, when you're in high school, there are no classes talking about your financial stability and what to do after. When you get to college, you're expected to know everything. So what exactly is credit? Credit is a number between 300 and 850. This number is used by lenders to determine your eligibility to receive a loan. The average American sits in the good category between 670 and 739. This is where I sit, and I have been building my credit for about 2 years. Exceptional category is between 800 and 850. Very good is 740 to 799. Very poor, 300 to 579, and fair is 580 to 669. This chart is taken from a FICO score, which is used on every credit score. So what exactly affects your credit and how it affects you? So 30% of your score is determined on the total amount you owe, whether that is on a loan or it's with your revolving credit. 35% is with payment history, so if you miss a payment, it's going to dock your overall credit. This payment history is monitored for up to 7 years, so if you miss a payment 7 years ago, it's going to always be on your score. 10% is new credit, so if you apply for a new credit card, this is going to dock you anywhere from 5 to 10 points. 15% is your length of credit history. As I said before, I've been working on my credit for up to 2 years, and I am still considered in the very poor category here. And the last one is 10% of the types of credit that you have. So if you have an installment loan for school, this fits in this category. If you have revolving credit or multiple credit cards, this also fits in this category. The more credit cards you have, the worse your score. So how to build credit? I have done extensive research on this for my own personal use. I am an independent student on my FAFSA, meaning that my parents do not claim me, and I don't get loans from them, like nothing affects in that way. So these are 3 that I have found have been the easiest, the top one being more independent, which is what I had to use. So with a secured credit card, what you do is you take a certain amount of money, anywhere from usually about $200 to $1,000, and you send that money directly to a company. I personally used Discover. It was the easiest, most accessible one for me. And you send that money in, and they use that as a security amount of money to make sure that your payments keep going and you can continue to build your credit. So say you put $300 in and you miss a payment. They'll take that $300, pay off your credit card, and then you are expected to keep going. If you don't use that money after about 8 months, they will return it to you. Another option you could do is be an authorized user on a parent's credit card. So if your parents have a credit card, they can add you as a user on it, and that will gradually build your credit as well. The last option that I found is the easiest is getting a loan. So if you don't have any credit, obviously you're going to need a cosigner that has credit in order to get that loan. You can say this loan is for a car, you can say this loan is for a camper, anything like that. It could be for a house, honestly, if you want to, but you're going to have a cosigner on the house as well. So with this loan, you just continue to pay it off, and this will build your credit the same way a credit card does or being an authorized user. So there are many different things that having a good credit score can do for you. The better credit score you have has lower interest rates on all of your loans that you may get. So mortgage rates, they're all going to be lower. Auto loan rates, they're all going to be lower. All insurance rates, all credit card rates, everything is going to be significantly lower with the better score you have. The lower your score, the harder it is to get loans, the harder it is to pay off everything because your rates are going to continue and you're going to forever be in debt. So overall, building your credit from a young age can help create a strong background in your future credit and overall financial stability.